Thank you all for being here. My name is Michael Gilroy. I'm an investor with Canaan here in San Francisco. As a firm, we invest all across technology and healthcare, and I focus on enterprise software and fintech. Really excited for the panel tonight as we're going to dive into the investment making process and how data is changing that process here. And we have folks from all across that ecosystem, from LPs to individual companies and another fellow VC here. So we'll dive right into the panel. We'll save your questions for the end. We'll have some time for Q&A, but Lisa, why don't we start with you for a quick bio?
Sure. Hello, everyone, and welcome. It's really cool to be in this place. I've walked by it many times, so it's fun to be in the Lending Club facility here. Lisa Edgar, I'm with a company called Top Tier Capital Partners. We're located here in the city in the Transamerica Pyramid. We are a venture capital fund of funds, which means we have investors ourselves, so we're a GP, but we're also an LP. We invest in funds like Canaan, which then invests in companies like Lending Club. So that's kind of where we fit in the ecosystem. We've been doing this for quite a while. We have over $5 billion of assets under management, all in venture capital. So there's a number of fund of funds out there that do private equity and might maybe do mezz and other things, but we are really solely focused on venture capital.
Arjun?
Hi, everybody. Social capital, start off in venture. I think we think of ourselves as entrepreneurial finance. So that means seed, venture, growth, and whatever may come in the future. My story is failed entrepreneur, success sometimes, big company, angel investor, seed fund, and then most recently at social capital. So we invest across a multitude of companies, stages, all life cycles.
My name is Ryan Caldbeck. I'm the founder and CEO of a company called CircleUp. CircleUp is an investment platform powered by technology. My background is in consumer-focused private equity. So when I say consumer tonight, I mean food, personal care, pet products, everything that is not sexy in this city, but makes up about 20% of our economy. In that industry, it's extremely difficult to get capital at the early stage. So companies with less than 10 million in revenue, it's very hard for them to get the money that they need, which we can talk about. We use a technology platform that we've built to find and evaluate companies, we think, more effectively than humans can alone.
Awesome. So Lisa, I'd love to start with you, given your perspective, seeing all these different venture capital firms come through your doors pitching their funds. What percentage of funds today are really talking about their data-driven kind of access or method to finding companies in the Valley?
Yeah, so I thought about that question a lot, through time, and there's only been a few that led with a data-driven strategy where their investment decisions are solely made through data. And the first one that came about was a firm called Correlation Ventures in 2006. And they would use all kinds of inputs and rate a company. And therefore, when a company came to them and asked for funding, they could make a decision really fast because they had a methodology behind that. And then there was Acadian Ventures, which invested in kind of direct secondaries. So they were looking at companies, so they had a score and that they would produce, and that firm has been around since around 2010, I think. And so there's been a few of them through time that was their strategy that they led with. And we're going to hear about social capital, which has now come to the conclusion that maybe some ways a data-first kind of screen to make an investment might be the best way. So it's going to be interesting to hear that. But I would say that today most venture firms absolutely use data, and they're much smarter in the way they use data and gather data and then what they can do with it. Deals used to get done, on the golf course, or if you were known as the best in your field, then the phone would actually ring and you would just pick up the phone and that's where the investments would come in. But we all know it's much more difficult today and you have to be very proactive. And one of the things that folks are doing is really trying to figure out how to get in front of things and use data to do that.
And I know we have a limited data set, but have you started to see a correlation with returns and funds that are using data as their primary method of decision making?
I think it's too early for anyone to say that the returns are there, but I will say that it's not new to use the data, right? I was at another fund of funds earlier in my career, and we actually had a database, and we were collecting data points just about going in valuations and sectors and stages and technology, locations, things like that, in order to actually make some sense of what was in the portfolio. And today at Top Tier, we've created our own proprietary database, and it contains that, but it also contains things like revenue multiples at exits, or revenue growth, or maybe expected valuations that the VCs think that these things are going to exit for. And I think inherently it's made us better investors, and I think most people are using the data because they believe that it makes them better investors, maybe just more informed, and to give you some guideposts on what you're doing.
Awesome. And so Arjun and Ryan, you guys are a step downstream. And Ryan, I know you in particular, you guys talk about the fact that you use 92,000 data points to analyze individual companies throughout the CPG market. Can you just talk a little bit about that process in your investment platform?
Yeah, that number, to be candid, is just a vanity metric. It doesn't really have a lot of
Substance?
Yeah, and it doesn't, to be candid. And so what I mean by that is the actual amount of data that we use is far greater than what we put in there. Mm-hmm. We're actually redoing that right now to kind of give a little more clarity and transparency to what we do. Yep. But those types of figures, like number of data points, tend to be candidly vanity. I think what matters more is what you can do with the data. Mm-hmm. And then what, the data or the algorithms. I think an important point to call out, though, is data is a very, very vague term. Mm-hmm. About as vague as just business. And we see a lot of private funds, whether it's private equity or venture, saying we have a data strategy, to your point. And then when you kind of scratch the surface, they've got one outsourced engineer somewhere else who's kind of part-time. Right. That is hard to kind of build a data strategy around. I think one of the reasons we haven't seen a lot of companies, or rather funds, lead with it is it takes a huge amount of investment. There's a massive barrier to entry to doing this in the private markets, namely raising, we think, tens of millions of dollars to invest into a team to go build that. Mm-hmm. So we can talk through kind of our data of the 92,000 data points. It represents hundreds of different data sets. We track about 1.3 million companies themselves, and then there's a tremendous amount of data about each of those companies. Mm-hmm.
And so you guys bucket that data across financials, team, industry, product, so on and so forth. Stepping back and looking at the data set more holistically, are there any patterns that you see or any of those categories that you find to be better indicators of success down the road?
Yes. It kind of depends on the category and size of company. A basic theme, so in our space, in consumer, there's just two beautiful things. One is that the business models are all the same. It's very different than tech, where you've got a cryptocurrency, a game for your iPhone, and a securities business. Right. In consumer, whether I'm selling you dog food, shampoo, or water, it's the same business model over and over again. So you can build models that evaluate it very effectively. The second thing that's just beautiful about the space is there's a tremendous amount of data on the companies. You can see where they're sold, what the end users think of the product, how different the product is itself. To answer your question, though, probably the most important metric that we've seen is just distribution growth, just number of doors that you're in, which sounds like a basic thing. The problem in this space is that getting that requires that you pull that information from literally hundreds of different data sets, and combine it.
Yep. And so Arjun, I'd love to hear a little bit more from you. You guys launched Capital as a Service last year, which is exactly what it sounds like. I'll let you explain it to the group, but the purpose of that is to remove the human bias from venture capital deals the way they're happening today. So can you quickly explain what Capital as a Service is for the group?
Yeah, I think before we get there, probably something to think through is just taking a step back on what it means to be data-driven and how do you make decisions. And so just real quick, Correlation Ventures, their whole thesis was if Andreessen, Sequoia, Kleiner makes an investment, we'll follow on. That's like their model.
Right.
So what's really important is what are people's frameworks? how do they think about it, and what do they do in order to make decisions moving forward? And if you look at, if you step back 10 years and you look at companies, or how many people here are product managers or engineers? Anyone? Okay, so and I come from product, so 10 to 15 years ago, you would kind of just have a hunch and say, I think this, I think that, let's just go put it out there. And then as time went on, you had instrumentation, different data sets, different sources of intent of customers that are coming in. I don't think you can actually, you can do the same thing in venture capital to a certain extent, and you can say, okay, now I have a customer base on two sides. One of my main sources of customers are founders, they're companies. So what are the life cycles and intent of where they come in, and how should we assess them? And then what are the instrumentation and data sets that you can use? So if Yahoo was version 1, and then you had Google, and then you had Facebook, and now these new companies that are coming out, I think they're just getting better and better and better. And if you look at venture capital over the last 40 years, it's pretty much been the same. It's Excel sheets, it's Google sheets, I'm not gonna have any tasks, and I'm gonna put everything in my mind. I'm just gonna let people come in, and that's gonna be my deal flow. And that worked for a long time, but now you have 24,000 companies starting per year. How do you assess that? Whereas it used to be 1,000 to 5,000 companies. And so you kind of take that and you say, okay, if I'm gonna take a broad-based investment approach, I'm gonna look at opportunities, how am I gonna do that? And what are gonna be my sources of intent? How am I gonna assess companies? That's the approach we take. And so we look at companies at each stage in each sector. So if you look at, we still do seed. We do CAS, which is one of the services, and we incubate companies internally. And we consider that as today our three-prong approach. And then we start thinking about, okay, well, when and how do we start deploying more and more capital? So for CAS specifically, it was more about, we don't see deals everywhere, and that's not just internationally. It's in Ohio, it's in Florida, it's in Atlanta, it's in even parts of upstate New York. It's more about like, how can we get access to entrepreneurs that are doing great things all over the world in locations where we just can't be. And we say this internally a lot, but like, you wouldn't ask AWS to be on just between 9 to 5, you would ask them to be on 24 hours a day, right? It's part of that. And so if we think about ourselves as entrepreneurial finance and how do we get better over time, we want to be on 24 hours a day, and then start thinking about how we can make products better over time, tailored towards the entrepreneurs.
Right.
But I would think, and I was just thinking about I had 4 funds come in today, and 3 of them were more seed focused. And they really didn't have a data-driven model, because when you're seed focused, it's more about your relationship and the network and what you're doing. But the one that was more growth, so they were looking at companies, at least 2 million in revenues. It was branded consumer. They absolutely talked about the data and the data-driven strategy. So 3 out of the 4 didn't really say much about it, and 1 definitely did, because there was actually data to analyze. So I wonder, the capital as a service model, that seems like it works when there is actually data to analyze, right? I mean, there is a difference there. I'm just calling that out because I think it's important, and why I said not a lot of the funds that came in talk about it, because that's not the method or the mechanism they're using in order to decide what to do.
Yep.
And I think just to echo that, there's data at different times of a life cycle of a company. And I think what people always run towards are revenue, user growth, retention, but there's other data before that. It's like, how is the company executing? What have they been doing? What's the speed at which they are committing code? What does that look like? What's that quality? And I think over time you get better and better at assessing companies and saying, it doesn't matter where they come from. They could be from Google, they could be from Facebook, they could be from Africa, but what's the speed at which they iterate? Yep. And I think that's how you start tailoring.
So that's a great point. So I'm curious if you guys are doing that now, how you do that as a VC, right? I think there's a lot of pushback from companies themselves, and I'd love to get your perspective here. But if I came to some of my companies and said, hey, I want to know exactly how fast your engineers are working, I may be shown the door pretty quickly. So I'm curious how you guys think about that aspect of the business as well.
Yeah, so I think if we were just a traditional VC and say, hey, we've got, as you mentioned, we have like this engineering, we outsource this stuff, we think of it like IT,
right?
And people would think differently. I think part of it is we speak the same language as the entrepreneurs. We are building stuff internally. Some of us have built companies in the past before, not 40 to 50 years ago, but like between 4 or 5 years ago. So I'll be very irrelevant in 10 years.
Yep.
But we have product and engineering teams there sitting. They're going through how they think about company building how they can help, how to set up the data infrastructure, what they've seen work, what doesn't work at the earliest stages. So we're there right from the beginning where we're thinking about making an investment. And I want to say as late as our term sheets are pretty clean. I think most people see that. And in our term sheets, we write, we want access to your data, and we will spit that data back to you, the way in which we interpret as well, data benchmarks, all that kind of stuff. It's not about us just sucking in all the information, but if we think about ourselves as, again, who our customers are and how do we be a better service-based orientation company, then we want to share exactly what we're doing at the same time. And so I think that that trade-off is pretty useful for a lot of our portfolio companies.
I think that's super important, and I'm sure you do it too, because we aggregate and blind the data and show, Canaan, this is where you sit and rank in our data set for the funds we've invested in. This is where you are on how much you've distributed versus others, or all that. And I think that's super helpful, because then people are like, okay, I'll contribute the data because then I'm part, I get something out of it, or I'm part of it.
Yeah, we found that to be important for our company. So when we're talking with a company, we'll often show them the data, or we always show them the data as a way to help encourage them to work with us. What we find is that they then often want to take that data and bring it to a retailer, show them why we should get on their shelves, or bring it to their board, talk about what's working, what's not working.
And so one other byproduct of the data that I noticed in your guys' blog piece was that the data said to invest in companies that were 42% female founded and a majority non-white, right? And so this goes against all of the other trends that we've seen historically in venture capital. Can you talk about that, and then maybe some other interesting things that have come out of the data there?
Yeah, I mean, I'd first say it's early stages of that program. As I mentioned, we have seed and the incubation at the same time, where seed is network driven, CAS is data driven, and the incubation is where we incubate ourselves, so it's more thesis driven. Yeah, I mean, I think part of it was that we wanted to open it up, not see who the teams were specifically, but just look at how they were executing, and were these types of businesses that we wanted to spend more time on. Would we invest in them? Did they have investable characteristics? And that was the outcome and the result. What that looks like over time and scale, I'm not sure, but it's positive to see those results, and it's also positive to talk to those people, whoever they may be.
Right.
I found that I was actually at their annual meeting last week, and they were talking about this, and I just found it really fascinating. I think it is a really interesting data point. And what it reminds me is my daughter actually plays the violin in an orchestra, and for anybody who knows how those auditions work, you're behind the curtain, you're blinded. So the people that are evaluating you can't see you. And it's almost like that. A data-driven algorithm is like almost a shield to who the person is, but you're then evaluating everyone off the exact same thing. And there's something kind of beautiful about that in a way. And I remember sitting there thinking about that last week too. So
I think the thing that's important is when people come in for a pitch, we're already making quick first impressions on people, how they speak, where they come from. And I think a part of what we're trying to do, I mean, some of those biases do exist, and we want to take some of that out, and some of them matter in context of how they're starting the company. But I think what we want to get to is how do we reduce the amount of time in the first impression and have context on the company, so that we can have contextual conversations about the company and then see how they're reacting to it over time. And I think that you just start off in a better place.
So we've seen a similar stat, actually, which is interesting that the two funds have a similar stat on that. We get really passionate about trying to democratize the process to raise money. I think I have always been very frustrated living in this city that it is extraordinarily easy if you are an engineer with a 10-page PowerPoint deck to raise money. If you live in Ohio and you've got a $5 million shampoo company that's growing at 100% a year, it's extremely difficult. And the returns would not back that up. The returns are pretty phenomenal in consumer. The problem is that finding them and getting that entrepreneur connected with the money traditionally has been, candidly, an old boys club. It is about actually on the golf course, to use your phrase from before.
I've never been to a golf course. I would really like to go to one.
We can go this
maybe in 10 years when you're relevant, that's where we'll find you.
And so we get excited about the opportunity to democratize that through data and not relying on just the network.
Yeah. And so we've talked a lot about why data is good. It's exposing things inside of businesses that we haven't seen before. It's democratizing access to capital. If we look at other markets, namely the public equities markets, we went from a period of time where 30% of trades were driven by algos, and now it's well over 99% of trades are driven by algos. we've had things like flash crashes, and we're now at a point in time where we're saying there actually aren't any humans creating checks and balances for these markets. Are there any negative ramifications of technology really kind of driving venture capital and the deals that are done here?
I mean, I think that has existed in publics for, you guys have a hedge fund, so you could probably talk to publics more than I could, but it's existed in publics for 30 plus years. Rentec is more than 30 years old. So I think we're a ways away, not just from a number of years standpoint, but just the maturity of the industry and how quickly a data-driven strategy can develop in private markets. The data is just not nearly as structured as it is in the public markets. It's much harder to do this in the private markets. One immediate thing that comes to mind, though, is what we were talking about before. If you don't have metrics, if it is a seed company, it's much harder, at least in my experience, it's much harder to do this. So for us, we only work with companies with revenue, companies with above $1 million in revenue. We can't service the ones below that nearly as effectively because there's not as much data. And maybe there are solutions to that in the future without just relying on the team, which then reinforces a bias I would worry about. But that's one obvious concern.
Thankfully, there seems to be a new seed fund every week popping up, so I think that segment of the market is covered.
In tech, yeah.
I think it's hard to answer that question on what it's going to look like and if there's going to be any negative repercussions from it. I think what not maybe utopian, but ultimately what you want to see is different classes of investing and different focuses all over the world to a certain extent. So I think our hopes are that, outside the United States, you're going to see more of ecosystems. Within the United States, certain pockets, you'll see more ecosystems where, as you mentioned, it could be old boys club, but there has to be when you're in college, it's not like the professor spitting out everything to you and that's how you learn. It's an ecosystem of other students at the same time. I think our goal as we look at all these places popping up, it's fine to have all these multiple seed funds. I actually don't think there's anything wrong with it. It's better. It's just where's their core focus, where they're spending their time, and how are they having impact. And if their focus is in Atlanta, if it's in Ohio, if it's in London, parts of UK, that's fine. And I think then our job is to where do we spend our time and where do we want to have our entry point?
And so I think, Ryan, obviously you focus on consumer and you as a mix of enterprise and consumer. Is there a difference between data-driven investing in consumer versus enterprise, and does it work better in one vertical versus the other?
We say two different things when we're talking about consumer. So I can't speak to consumer tech versus enterprise, but consumer products, it's what I mentioned before. It's the same business models, and there's just an outrageous amount of data. If you Google the smallest brand you'll ever find, there's an incredible amount of information out there that we don't need them to give us. It's already there for us to evaluate, and that data turns out is very predictive of success.
If you think about any business model, they're pretty much all the same. It's just at what point do they get there? And so, you can think about hard tech enterprise data infrastructure companies, what is it that they need, how much capital they need in order to get to, first principles of their customer base. Is it top down, is it bottoms up, and then consumer SaaS, consumer enterprise, consumer products, is it subscription based, is it social gaming, et cetera. I think what it really comes down to is how do you just assess each company in their verticals, their ecosystem, and then what's the underlying data that you care about or leading indicators that you care about, and how much capital do you want to deploy towards that experiment versus its product market fit versus when they get to a certain scale.
Awesome. So we have one more question and then we'll open it up. And I'm not sure if we have a mic floating around, but that would be great if we do. So I want to ask you all to look into your crystal balls for a second and think about what a venture capital firm of the year 2030 looks like, how they operate and how they make investment decisions. And Lisa, you're seeing all of these at the forefront, so I'm curious to get your perspective first.
Yeah, it's just, there's always a new model and people can get so creative, so it's so hard to really expand your brain and come up with something. I guess I kept thinking, is it all data driven or is it relationship driven? Just more going on those 2 points. And I do think venture capital, it's a people business. It just really is. People work with who they want to work with, and I don't think that ever goes away. Just the connections that people make, and who's in your network, and how that gets done. I think it's certainly a bigger business. It's no longer a cottage industry. It's global. It looks, much more mainstream. It's getting more mainstream now. We got a HBO show, and everybody wants to be a VC, and it's just. My mother even knows what I do for a living now. She's actually said the words venture capital, So I just think it just gets more mainstream, and it continues to be the way, though, globally, that technology is funded. I don't think that changes.
Mm-hmm. Go down the line, Arjun.
I'd echo what she's saying. I think the difference is you're going to see, I think you're just going to see a proliferation of more capital at the earlier stages in different locations. And then probably some consolidation in certain key markets like we have here in like oversaturation. And then you're going to see more funds again, like SoftBank coming in and saying like, okay, well, where do we fit in? And then who fits in the middle again? I think you're going to see the pendulum swing both ways. To be frank, you've seen it for the last 20, 30 years too. And so what does that mean moving forward? I've lived here my whole life. I've heard funds that were $3 billion under management and no longer exist today because of a certain key value proposition. So I think venture capital is here to stay for a while, much past my life. But I think what is really important is that the types of companies that get created, what venture capital used to fund versus what they're funding today, CPG over time versus hard tech as it was before. I think you're just going to see a proliferation of how you also saw the public markets. As an investor, where do you think you're going to see returns? Where do you want to see that in innovation? And then where do you fund hard tech versus just a good business model?
So I think the dollars put to work increases. I think the number of funds, at least here in the US, decreases. I agree with Arjun about it being more global. My hope is that firms like Top Tier and other LPs effectively over time can release returns on the funds. I think there's a lot of funds in the country that should not exist, to be candid. And it's a very opaque industry, so it's hard to get that information. So it's relatively easy to, after you raise your first fund, you can stay in business for another fund or two, even though the returns aren't great. Some fintech company is going to come along and try to aggregate those returns and expose it, which will lead towards a consolidation.
Right. I know it's the last question, but I would like you to respond to that. What's your point of view on what Ryan just said?
He's right. We're asked to make an investment decision on a re-up 2 or 3 years after the previous fund, so there really aren't returns. And it is an opaque industry. There is a FOIA, Freedom of Information Act, for the public funds that invest in venture, and that's public information. And there's a lot of, whether it's Preqin or PitchBook, there's some data out there, which is some is good, some is not so good, Cambridge, but you can't get the details. We have a lot of details in our database. We have a great database, the Mine. We've been gathering it for a long time. So we do have more information than others, and we use our data to sort rank, and that's how we make the investment decisions. But I agree. It's private. It's part of private equity, not public equity, though, and I don't know if it's ever going to be is available, the returns as people would want them to be.
I can dream.
Yeah, you can dream.
Just to be
it's
clear, Top Tier is a phenomenal LP. I just meant they have data, just like other LPs have data, and that if anyone was ever able to consolidate that, I think there'll be fewer funds, not more.
Awesome. Questions from the audience? So I'll repeat the question. I think I got it, which is in the public markets, there's equity analysts that allow investors to aggregate data and make an investment decision. In the private markets, that function does not exist, so everybody's kind of doing their work one-off and making the investment decision. Did I get that right? Okay, great.
The only kind of groups that act maybe as the research analysts is somebody like Cambridge, the consultants, who then you hire, and they're doing the research reports, and then you get it from them, and they're seeing enough, and they're kind of trying to tell you what to do. But once again, that their data is not publicly available unless you pay for it. Your question, though, is kind of interesting, and there's been numerous people that tried to play this, and we even thought about it many times, is that as a private investor, and see, this is a social capital thing too. As a private investor, you have a lot of information about these companies, and now they go public. So you are much smarter public investor if you've gone through, the private life of those companies. And so that's where, like, the hedge fund part comes in, that you can actually have a little bit of leg up, and you have information that no research analyst would have, for example.
Yeah, and I would just say on the company investment side, there are a lot of tools that are starting to aggregate that. Things like Aptopia and Second Measure that you can create reports on individual companies depending on what vertical they're in or what they're doing. But yeah, it does not exist in a more formalized way. We've talked about historical data here, and there are clearly historical data biases. What are the ways around that?
Yeah, so one great thing about a company is that it's an entity or being in itself, and anything can happen. And so it could fail for 4 years straight, and the data could just be fucking terrible. And then one day it could just pop up and say, hey, I've changed my model in the way in which I'm thinking, and it could just change. And I think whenever we're looking at models, we're not really going back and saying, hey, you know what, over the last 6 years, this is the performance. Yes, we could take a look at that. If that's all you've been doing, then it's like an easy pass and say, thanks for coming in, you haven't changed, and you've grown at 0% year over year. I don't even think they would show up. But I think like a lot of what we're talking about is company building in early life cycle, and then a lot of the decisions we make are actually not on historical context, right? It's really rare where we'll see a company where we have 3.5 years of data. It's usually 3.5 months. And so you're looking at that and saying, okay, company's ARR, how long did it take for them to go from 100K to $1 million? Or just from 0 to 100K or 50 to 100K, where are they going? Are they top down? Again, I'm just talking enterprise here. Bottoms up, what's that? What does retention look like? I think you have to put all of these things together. And so I don't think there's gonna be too much biases in a lot of these, unless you're saying, I'm gonna assess a top-down SaaS enterprise company the same way I look at it from a bottoms-up company. So you have to kind of think about frameworks, and your framework could be biased around, like, I don't like top-down SaaS companies, and that's just the investor's choice.
Yeah. But
go ahead.
Sorry, we were actually talking about some of these consumer finance companies that are using absolutely different data sets today to actually do scoring, and it's not the FICO approach of the past that probably had inherent biases in it. Maybe even because what data was available. I think there's a lot more points that you can add to that, and a lot. So I think there are ways to get around that today, and you can start a company from scratch that actually looks at different things. And there's people doing this globally because, frankly, that doesn't exist in other countries. In Asia, you don't have that, so they figured out other ways to do it. And that would be my answer, that you don't go backwards, you're going forward.
I think the underlying issue is that you're talking about the FICO score. We don't have any underlying scores that we rate people or companies by in general, except for their performance.
Do you mean FICO score as an input or the output of the data? I think you meant input, right?
Well, I was thinking more of an input,
Yeah.
yeah.
The woman in front of you is one of our senior data scientists. I'm really tempted to put her on the spot and make this a group discussion, but I won't. So I think there's data availability in terms of like the inputs to the model. So we want to see if distribution or features about a product or the brand are connected with success. Then there's data availability about the outcome. What is the success measure? And what you talked before about gender as an example. In the case of venture, so we talked before about 40% of 35-40% of CircleUp companies are women-led. If you look at traditional venture, I think it's like 2 or 3%. I mean, it's obscenely low. If you wanted to look at that as an output measure of whether or not gender mattered, there's just very little data to look at, which makes it really hard to test, right? So one of the challenges for us is looking for both sets of data and backdating or back collecting both sets of data in a way that's large enough that you can find some statistical significance. So we're not trying to find if, let's say cryptocurrency, right? How many successful cryptocurrencies that have actually exited are there? 5, less than 5, 0. So if we're trying to look for a success measure in cryptocurrency, now we can't look at exit, we have to look at something else. Well, we don't have revenue on them, so now we're out of luck in that category. So that's a challenge.
Market cap.
Market cap. You could look at market cap if you believe valuations in tech.
I don't think that's a good indicator.
We'll do one more question right here in the front. So I think the question was, portfolios like CircleUp give you a more diversified approach, whereas traditional venture firms tend to be more concentrated in their exposure. Is that right?
Yeah.
Why hasn't that changed?
Well, I think I said before, I've been in the business for a long time, and we were always taught ownership matters. And there are differing opinions on this, and there's a number of funds that have been created and continue to be created on this, but concentration in venture is generally better than not. We're a fund to fund, so we're well diversified. But if you were to invest in a fund, generally they're trying to create enough diversification in that fund to give you the outputs that they expect. So this many losses, this many returns of capital, and this many outliers to get the performance that they need. Diversification isn't necessarily a good thing. I mean, at one point it tips over and it's too many and it's not really helping you. So that wouldn't be the reason that I wouldn't go data driven to get more companies in the portfolio to think that's going to be a better outcome. Historically, that has not produced a better outcome either.
I think part of it's the category. So in tech, there's more of a power law dynamic. Social capital can invest in a company and earn 1,000 times their return. If you're in Uber or Lyft, you guys are in one of them now. They're in some amazing companies that'll be massive home runs. In consumer, there isn't. Slack, yeah. They're in a bunch of fantastic companies.
He's speaking.
We're because of that. Like I don't think you need to make 1,000 bets if you are right on a couple. In consumer, it's much more. There's a ton of doubles and triples, candidly, and it would show that diversification matters a bit more in this space or in consumer. But I agree with the point Lisa made about tech.
I think just to remember, we're talking about venture capital. So like some people call it adventure capital, risk capital. This is a risk category investment area. So it's not like the LPs that are coming in here aren't saying like, I want a 6% return. That's real estate or fixed income. They're coming here and saying, we're looking for non-correlated returns to the rest of the market. They also believe in certain theses. So some LPs care about education, some care about healthcare, some care about like financial. So I think you have to kind of think about that. And depending on what the firm is focused on, you are going to see them very focused on certain areas, and you're going to see them doubling down on areas where the returns can be great or it could be risky at the end of the day. And I think you'll have to look firm by firm how they spend their time, but plenty of them have started saying like, we're going to put a lot of our fund on the line on one or two companies, and that may be in a great investment or it might be bad. But I think I'm generally not a believer on portfolio construction, especially in venture.
Yeah, I think you're also coming at concentration from a kind of negative standpoint, going back to one of the earlier comments around this is still going to be a human-driven business. I'm going to pick on my friend Jeff here at NICA, right, where they're a fintech-focused seed fund. I think being focused and concentrated on a certain vertical can really be very beneficial and have synergies through relationships and co-investors and so on and so forth. So I think there are certain situations where it actually is a very, very good thing to be specialized in one category and be the leader there, whereas if you try to do a lot of different things okay, you're probably not going to end up very good. Awesome. Well, thank you guys so much for joining the panel here, and thank you everybody for coming. We will have more drinks and food, so please join us after this. But thank you.